It's been a tough, if unusual, start for investors across investment markets this year. Tough because, as most people will know, we've seen negative returns in equity markets over the first 6 months. But what's been unusual has been the fact that we've also seen the bond markets sell off over the same period. This is unusual because traditionally these markets operate inversely to each other. When equity markets are going down, we usually see a rally in bond markets and vice versa. Therefore, as we look through the rest of the year, the big question for many people will be whether this trend will continue. The other aspect about the first 6 months has been from a sector perspective. Not surprisingly, we've seen a very strong move in energy sector, particularly those companies very much geared into oil and gas. But also interesting has been the fact that the other sectors that have outperformed are the likes of the more defensive ones of healthcare, consumer staples, and utilities. The more cyclically orientated sectors like industrials have performed roughly in line with the market over this period. The big damage, though, has definitely been done by the larger weighted industries like technology, like consumer discretionary, and like communications. Because of their weight within indices, their performance has had a disproportionate effect. The other thing to bear in mind about the first 6 months of this year is the fact that what we have seen is really a derating of the equity market. Earnings growth from corporates has remained strong and, if anything, has actually improved over the first 6 months. So the PE, or the price-earnings ratio, is really where we have seen the major change in the markets. Now we have seen this come down to close to its long-term averages for most of the major markets. As we go into the second half of the year, the big question for many people will be whether we see a recession and what, if anything, that will have an impact in terms of corporate earnings. If there isn't a recession, and it's certainly our base case that there won't be a recession in the second half of this year in the US and in Asia, there is still a chance, obviously, of a recession in Europe should we see a switching off of natural gas. But bar that, we should avoid a recession in Europe as well. In the absence of that recession, corporate earnings growth should probably hold up through that period. And the big question for investors will be whether the derating that we saw in the first 6 months can be unwound. The final big thing to bear in mind has been the strength of the dollar over this 6 months. Again, against all major currencies, this has been a feature. This will have an impact on corporates, particularly in the US, to the downside because so much of their profits come from overseas, but actually it does have a positive for many European companies given the strength of their export markets. All told, the big key will be whether we see a recession and what the likely finishing point is for interest rates.